Okay, let's dive into this. Welcome to today's Explainer, where we're going to unpack one of the most fascinating and honestly profoundly overlooked mechanisms running our modern economy. We're talking about a system that traditional financial media completely ignores, mostly because, well, it takes a bit of patience and nuance to really get it. But I promise you, stick with me to the end of this presentation, and you're going to see exactly how the global financial machine truly operates. We're looking at what I like to call the hidden duct tape of global finance. Now, you might be wondering, why do mortgage rates just absolutely refuse to fall? I know a lot of you are probably feeling a very specific type of frustration right now. You look at the news, you hear the Federal Reserve talking about cutting rates, and you think, awesome, finally some relief is coming. But then you go to look at a house or you check your retirement portfolio, and financial conditions still feel incredibly tight. Stocks randomly freak out every few months, and those mortgage rates simply refuse to meaningfully budge. It feels totally disconnected, right? Like the math just isn't mathing. Well, naturally, when things don't make sense, we tend to point fingers at the loudest suspects. We blame the Federal Reserve, we worry about some massive AI bubble popping, or we just point to whoever happens to be sitting in the Oval Office. But here's the crazy twist. The answer to our current economic friction doesn't actually start in Washington. It starts in Tokyo. More specifically, it traces all the way back to arguably the most boring asset on Earth: Japanese government bonds. For the past 30 years, Japan has quietly been the duct tape holding the whole global financial system together. And right now, that duct tape is literally starting to peel. Let's see how this all builds. Section 1. The Global ATM, Rewinding to 1992. To truly understand why Japan wields so much invisible power over your wallet today, we kind of have to rewind the clock. 30 years ago, back in 1992, Japan experienced a totally catastrophic economic event. Their massive asset bubble burst, real estate collapsed, equities collapsed, and the whole country entered what economists call the lost decades. For a 30-year stretch, they experienced virtually zero real growth, no inflation, and absolutely no wage expansion. It was like their entire economy hit pause and nobody could find the remote. So what did the Bank of Japan do? Well, they did what any central bank does when they're out of options. They slashed interest rates to zero, and then they actually cut them below zero. But when even that wasn't enough, they introduced a very specific radical policy. They introduced yield curve control, or YCC. Now, I know, yield curve control sounds a bit like a Marvel villain, but the concept is actually pretty straightforward. It just means the central bank decides to cap long-term bond yields at a specific target, completely ignoring what the free market actually wants. Essentially, the Japanese government took superglue and pinned their interest rates straight to the floor. So for decades, Japanese government bonds yielded pretty much nothing. Literally 0%. Now, I want you to put yourself in the shoes of a Japanese investor for a second. Imagine you're managing a Japanese life insurance company, a pension fund, or a massive bank. You're sitting on a multi-billion-dollar investment portfolio, and your own domestic government bonds are paying you absolutely zero. You're faced with a pretty stark dilemma. Do you accept a 0% return on your massive pile of cash, or do you take those billions of dollars and go shopping overseas for higher yields? Unsurprisingly, they chose option 2. Section 2, the yen carry trade, running on Japanese Wi-Fi. Now, what's really interesting about this slide is how this 0% dynamic turned Japan into the world's absolute largest net creditor nation. It literally became the world's ATM. And look, it wasn't because Japan just loved sending capital to America out of the goodness of their hearts. It was simply because the math made too much sense. Let's break this down step by step using a theoretical investor. We'll call him Bob. Bob wants to make a safe, easy return, right? So, step 1, Bob goes to the Japanese markets and borrows money in yen at near zero interest rates. Step 2, he converts that yen into US dollars. Step 3, he takes those dollars and buys US treasuries that yield, let's say, 4%. And finally, step 4, after covering a few minor hedging costs and fees, Bob just pockets the spread. This brilliant little maneuver became known as the yen carry trade. Borrow cheap yen, invest high in dollars, and essentially print free money. And here is the absolute kicker. When borrowing costs are basically zero, investors don't just stop at buying safe US treasuries. No way. They buy tech stocks, they buy real estate, they buy into emerging markets. Basically, if an asset had a pulse and yielded more than 0%, Japanese capital was there to buy it. For years, this trade became one of the absolute largest sources of global liquidity. At its peak, major banks estimated the yen carry trade was worth trillions of dollars. Like the quote says, the global markets were literally running on Japanese Wi-Fi. Section 3, the unwinding begins. The math flips in 2024. Now, this entire global financial engine relied on a single, incredibly fragile assumption. And that assumption was that Japanese yields would stay near zero forever. But in 2024, that assumption totally broke. The Bank of Japan officially ended its yield curve control policy and raised interest rates for the first time in 17 years. Just let that sink in for a second. A 17-year streak of basically zero-cost capital came to an abrupt, screeching halt. And then, well, shortly after, they raised them again. The shockwaves from this were immediate and, quite frankly, brutal. Following that second rate hike decision, global markets violently repriced. We saw the S&P 500 drop 6%, and Japan's own index, the Nikkei 225, absolutely plummeted over 12% in a single day. That was actually its worst single-day drop since the infamous crash of 1987. Markets were officially spooked. Because think about it, when Japanese yields rise, borrowing in yen suddenly becomes way more expensive, and hedging currency risk gets more expensive. That free money trade we talked about, suddenly it wasn't so free anymore. The math had officially flipped. And, when the math flips, the capital flows flip right along with it. This brings us to a really critical concept, repatriation. Simply put, it's the return of capital to its country of origin. So all those trillions of dollars that flowed out of Japan for decades, just hunting for yield around the globe, they started to turn around and violently flow back home to Japan. Investors suddenly woke up to the really uncomfortable truth that the cheapest source of global liquidity for the last 30 years was just gone. Section 4. Why money costs more. The supply and demand shock. So, the crucial point is, why does this actually matter to you? Why on earth does a change in Japanese interest rates affect an everyday American trying to buy a house or a local company trying to expand? Well, we have to clear up a massive misconception that just gets repeated endlessly on financial news networks. Everyone hyperanalyzes the Federal Reserve and Jerome Powell, right? But here's the secret. The Federal Reserve only controls short-term rates, basically the overnight rate. But the 10-year, the 20-year, and the 30-year Treasury yields, those long-term rates are largely dictated by pure, unadulterated supply and demand. Legendary investor Ray Dalio actually perfectly encapsulates why this is so dangerous. As he points out, the bond market is the backbone of all markets. It determines what all asset returns are going to be. So when there's a breakdown in the supply and demand picture for bonds, interest rates are forced up, completely regardless of what the central banks actually want. It puts the Federal Reserve in a total bind. Everyone is staring at the Fed, waiting for a rate cut, completely ignoring the actual supply and demand mechanics happening in the bond market. And folks, that supply is staggering right now. The U.S. Treasury has to issue massive amounts of new debt every single year just to fund these trillion-dollar deficits and keep the lights on in the economy. Now, as this huge issuance of debt keeps growing, someone has to be willing to actually absorb it. And for the last few decades, Japan was that reliable, consistent, price-insensitive buyer that kept the whole machine running smoothly. Section 5, the domino effect. Liquidity is the oxygen. And this brilliantly illustrates exactly what happens if our biggest historical buyer packs up their wallet and goes home. If Japan stops buying, the U.S. Treasury still has to sell all that debt. So to attract new buyers to replace Japan, long-term bond yields have to go up, or at least stay elevated, which triggers a pretty brutal domino effect. First off, stock valuations compress. Analysts use long-term yields to discount future cash flows, right? So if yields are high, the present value of those future earnings drops, meaning stock multiples shrink. Second, mortgage rates are anchored to the 10-year Treasury, not the Fed's short-term rate. If global demand for our debt weakens, that 10-year yield stays high, and honestly, your dreams of a 3% mortgage are effectively dead. And finally, corporate credit tightens. Companies stop borrowing, risk appetite falls, and economic growth just slows down. Now, you probably won't hear much about this on the evening news. It's just not a clickable headline. People want to argue about politics or, marvel at the latest AI stock surge. We are constantly sold this oversimplified lie that one simple Fed rate cut is going to automatically fix everything, and that endless global liquidity is just guaranteed. But the reality is that the real threats in markets aren't the loud ones. They're the structural shifts hiding in plain sight. Which leaves us with this final, provocative thought. We've spent 30 years benefiting from the world's absolutely largest carry trade. Liquidity is the oxygen of the markets. So I leave you with this question. What actually happens to the global financial system when the largest foreign buyer of U.S. debt decides to finally take a step back? The cost of money is fundamentally changing everywhere. Thanks so much for joining me on this explainer. Keep your eyes on that bond market, and I'll catch you in the next one.